Happy Monday, everybody. I hope you had a great weekend. It's time this week to pay attention again. There will be a few big events as the end of summer is upon us, and so many people are not yet coming back to the trading desk, possibly another week. But overall, we should be getting more volume coming next week. Not this week so much, so watch for bigger swings. Today is August 26, 2024, and this is your Monday market update. Let's do what we do here on Mondays. Let's review last week's market action and what it seems to have meant to you, and then let's preview this coming week's expected news and events. So we jump right in on Monday. The U.S. stock market continued its rally from early August. The market largely ignored modest economic data releases, including a 1.3% rise in e-commerce retail sales and a negative 0.6 decline in the leading indicators index, both of which had minimal impact. The market's momentum is being influenced by expectations of a Fed rate cut in September, supported by recent dovish comments from Fed officials. Commodities had a mixed day, with oil prices declining sharply due to easing geopolitical tensions in the Middle East, while gold reached new highs, supported by a weaker dollar. The dollar index fell to a new low for 2024, driven by dovish Fed speak and then disappointing economic data. This continued rally and market stability seemed to be contingent on external factors, particularly the yen's strength, which could include volatility if it strengthens again. As there was little change in the narrative, market momentum kept things on the upside. The Dow closed up 0.5%, the S&P almost 1%, and the Nasdaq up 1.33%. This marked the 8th consecutive day of gains, driven by a combination of bullish momentum, short squeezes, and traders chasing the rally. Markets tried to extend the winning streak on Tuesday. There was some early excitement on tech earnings, Palo Alto this time, but that did not hold. The yen strength and the Fed speak, that was pretty much all you got on Tuesday. So there was little to keep things from finally seeing some digestion of the recent moves. The stock market's best stretch of consecutive gains this year ended as major indices pulled back slightly, with the S&P 500 dipping just about 0.25%. The decline was driven by a pullback in big tech stocks and a lack of follow-through on the rally as traders digested the gains made since early August. The market remains cautious as the traders await key data, including Thursday's flash PMIs and Fed Chair Powell's commentary at Jackson Hole on Friday, which could influence whether the market continues the rally or pulls back further. The Dow was down slightly. The S&P was down, like I said, about 0.25%. The Nasdaq was down 1/3%. The U.S. stock market rallied once again on Wednesday as markets got two main news events. The Bureau of Labor and Statistics revised job additions downward by 818,000 jobs for the period from March 2023 to March 2024, which was worse than the expected revision of negative 600,000. Despite significant downward revision, which reduced monthly jobless gains from 221% to 174%, markets were not overly concerned about a recession, viewing the labor markets as still relatively strong. The July FOMC minutes were slightly more dovish than anticipated, reinforcing the expectation of a rate cut in September, likely by 25 basis points. This did contribute to a rally in stocks and a decline in both the dollar and treasury yields. Overall, the stock market's rally reflected some optimism about a potential soft landing and upcoming Fed rate cuts, while bond and currency markets signaled caution over slowing economic growth. The divergence here between the stock market's optimism and the bond market's concerns remains a key area for focus for investors. Focus maybe, but of course not enough to sit on the sidelines. In the end, investors digested revisions to the labor market data and release of the July FOMC meeting minutes, which increased expectations for a 50 basis points rate cut in September, potentially. By the end of the day, the Dow was up slightly, the S&P was up almost 0.5%, the Nasdaq up 0.5%. The market saw increased volatility on Thursday as recession fears resurfaced following the release of the August flash composite PMI and inline jobless claims. Markets opened higher, but after the UCO data started, we saw the reversal. The S&P Global Composite PMI for the U.S. came in at 54.1, slightly above expectations, but with concerning details. The report highlighted a deteriorating manufacturing sector, raising doubts about the soft landing scenario and reviving recession fears. Investors are now closely watching Fed Chair Powell's speech for signals on future monetary policy. All eyes go to Jackson Hole. The Dow closed down about 0.5%, the S&P down almost 1%, and the Nasdaq closed down 1.75%. Markets were on the edge of their seats on Friday. As Friday came along, Jay Powell's speech in Jackson Hole. About this time 2 years ago, he started the whole hiking cycle with this speech in Jackson Hole. So traders and markets are looking for him to hit the start button on the cutting cycle now. Stock market surged as Federal Reserve Chair Jerome Powell signaled that interest rate cuts are on the horizon. Though he did not provide specific details on the timing and the magnitude, his statement, quote, "The time has come for policies to adjust," close quote, was well received by the market, leading to strong upward momentum. Tech stocks led the way with hopes of lower rates, and the rest followed. Clearly, markets view this recent tailwind for stocks as something new. And as I've been telling you, these markets, with their good market playbook, see it fit to take the stocks higher on the same news over and over again until they don't. I will remind you that the AI story, though still very strong, was a they can do no wrong story for weeks, if not months. These stocks are still off their highs, well off their lows, I'll give you, but tell that to the people who bought at the recent high before someone stopped to breathe. And remember that there are costs associated with the AI theme, and monetizing those costs into profits is not yet understood in many cases. I'm not saying they won't happen, but I am just reminding you, rose-colored glasses do fog every now and then with reality. But for Friday, tailwind was enough. News of the day led to strong rally across the major indices, with the Dow up almost 1.25%, S&P up almost 1.25% also, and the NASDAQ up almost 1.5%. By the way, if you've been paying attention, these percentage moves are not really worth all the big headlines they received. But we're getting close to thin oxygen level again, so upswings are harder to come by. For the week, the Dow was up 1.33%, S&P up 1.5%, the NASDAQ was up almost 1.5%. The anticipation of rate cuts provided a tailwind for equities, helping the major indices close this week on a strong note. Let's look into the coming week. As I mentioned, there are only a few items, but they are pretty big. First, the Fed heads are back, regardless of the fact that I still think the September rate cut will be a foregone conclusion until some big eco numbers, namely Friday's PCE, then the September jobs number. Fed heads this week, Daly, Waller, and Bostic. Then for the eco side, we'll get PCE on Friday. Recall, that's the Fed's supposed favorite to watch for inflation. And we'll also get GDP from Q2 and University of Michigan survey results. The big market mover, I think, will be Wednesday after the close, when one stock that no one can leave out of any market conversation, NVIDIA, will release earnings. The CEO will speak, and I'm sure he'll be a great cheerleader. Watch to set the tone of the market. Remember this: it is not really what he says. It is how the algos and the traders interpret what he says. So short term, we cannot even guess which way it'll go, but it will probably set the tone. We'll also get earnings from some other big tech names, Salesforce, Dell, and CrowdStrike, then some retailers, Ulta Beauty, and Dollar General, to name a few. So this week will be slow but active. I will add that although we do live in historic times, since 1944, August and September have been two of the worst months of the election year in terms of price returns. October usually tends to rebound in election years, according to MarketWatch. It is 35% more volatile than the average month. So it's time to wrap up your summer plans and pay attention this week. But as always, this is just the short-term story. Please remember the long-term is all about your goals, and they should not start with the worry about what will happen this week. Come back on Friday for the planning video, and please keep in touch as the summer comes to a close and students head back to school. There's a lot to talk about with that and so much more. So stay in touch and have a great week.